So if you run your own business or you're just pulling in a good income, you know that feeling, right? Seeing a healthy balance in your bank account, it feels good. But what if I told you that you could take that cash you worked so hard for and build something that pays you just for owning it? That's what we're breaking down today. Exactly how to turn that active income into a real, honest-to-goodness passive income stream. Let's jump right in.
Okay, let's just imagine for a second. You crushed it this month. A fresh $40,000 just hit your business account. Man, that's a huge relief. But then that big question pops into your head. Okay, now what? I mean, letting it just sit there in the bank, it feels safe, doesn't it? But I'm going to make the case today that it's actually one of the riskiest things you can do.
And here's why. This is the hard reality we're all living in. With interest rates in the basement and inflation quietly eating away at your money, that 40 grand is losing its punch. It's losing its buying power every single day. The old advice we all got from our parents, just save your money, well, that's a recipe for slowly going broke. Your money isn't working for you. It's just evaporating.
So here's the game plan for today. First, we're really going to dig into that $40,000 problem. Then we'll look at two totally different ways to invest, and this is huge, the cash flow way versus the capital gains way. After that, we get our hands dirty and actually build what I call a dividend engine. We'll even look at a cool strategy called the wealth wheel to supercharge it. And finally, we'll wrap up with how to manage this whole thing like a pro and the mindset you absolutely need to make it all click.
All right, let's kick things off with that 40 grand. Why exactly is letting cash just sit there the biggest roadblock to building serious wealth? Here it is. This is the fundamental mindset shift. You see, professional investors, they don't see cash as the final destination. It's just a tool. It's a temporary pit stop. Its only real job is to get traded for something that can make more money, an asset. Think of it like this. Your cash is like a pile of raw steel. You wouldn't just let it sit in a warehouse and rust, would you? Of course not. You'd use it to build an engine, and that engine could be a rental property, another business, or in our case, a portfolio of great stocks. And that brings us to this massive fork in the road for any investor. Are you playing the capital gains game, or are you playing the cash flow game? Seriously, the path you pick here defines everything about your financial future, and I'm going to show you why one of these is the pro's choice for achieving real, lasting financial freedom.
This table right here, it lays out the two mindsets perfectly. Over on the left, you've got capital gains. This is the classic buy low, sell high strategy. It's what most of us know from our 401ks, right? The value bounces all over the place, but you can't really use that money until you sell. But now, look over at the right side, cash flow. With this approach, we honestly don't care that much about the day-to-day price. What we care about is the consistent, regular, spendable income that asset spits out. Think of a solid company like Procter & Gamble. The stock price might wiggle, but that dividend check, it shows up like clockwork. That's real money you can actually go out and use.
And this quote just hits the nail on the head. This is the big secret, hiding right out in the open. Amateurs get all excited chasing that thrill of a stock doubling, watching their net worth jump up on a screen. But the pros are busy building systems. They build machines that generate predictable, boring cash flow. And why is that so critical? Because you can't pay your bills with net worth. You pay them with cash. Real financial freedom isn't some giant number in your brokerage account. It's when your passive income is greater than your monthly expenses. That's it. That's the whole game.
Okay, so theory is great, but how do we actually build one of these money machines? Let's get down to brass tacks. We're going to take our 40 grand and start putting together our dividend engine.
Now, before we build the engine, we got to understand the fuel. And for a stock, that fuel is called earnings per share, or EPS. It's a really simple concept. After a company pays all its costs, salaries, rent, materials, everything, the profit that's left over gets divided up by all the shares out there. That number, the EPS, that's your slice of the profit. It legally belongs to you, the shareholder. It's your piece of the pie.
So the company has your slice of the profit. What do they do with it? Well, they've basically got two choices. They can pour it back into the business, spend it on research for the next big product, build a new factory, pay off some debt. That makes the whole company more valuable over time. Or their second choice is to just send that cash directly to you, the owner, in the form of a dividend.
And this slide really shows you those two different philosophies in action. You've got a company like Apple. They are all about growth, so they're going to reinvest a huge chunk of their earnings right back into the business. As an owner, your main reward comes from watching the stock price climb. But then you've got a company like Procter & Gamble. They're a mature, stable business, so they're more likely to pay out a bigger slice of their earnings directly to you as a dividend, giving you that steady, reliable return. See, neither one is better. They just have totally different goals.
So where's the sweet spot for us cash flow investors? Here's a fantastic rule of thumb to keep in your back pocket. Look for companies that pay out about a third of their profits as dividends. Why? Because that shows they are serious about rewarding their owners with cash. And the other 2/3? That gets reinvested back into the business so it can keep growing. You really get the best of both worlds. You get cash in your pocket today, and you get growth for tomorrow.
Okay, our dividend engine is built. It's humming along, spitting out cash flow. But what if we could add a turbocharger to it? Yeah, that's what we're doing next. We're going to look at a more advanced strategy to squeeze even more income out of the very same stocks. We're going to be talking about options. And don't let the words scare you. Options are just contracts, that's all. They give someone the right to buy or sell a stock at a certain price. And we're going to use them to our massive advantage.
So the first piece of our turbocharger is something called a cash-covered put. It sounds way more complicated than it is. The idea is simple. You find a great company you love to own, but you look at the price and think, it's a little high right now. So you sell a put option. It's basically like making a formal lowball offer to buy the stock at a price you choose. And here's the best part. Just for making that offer, someone pays you cash right up front. It's called a premium, and you get to keep that cash no matter what happens. You're literally getting paid to name your own price on a stock you already wanted to buy. It's incredible.
Okay, the second part of the turbocharger is the covered call. This is what you do after you own the stock. Now think about it like this. If you own a rental house, you collect rent, right? Well, you can do the same thing with your stocks. By selling a call option, you're essentially renting out your shares. You get paid cash up front, and in exchange, you just agree to sell your shares if the price goes up to a target you set. It's just another amazing way to generate income from an asset you already own.
Now let's put it all together. This is the wealth wheel. It's a beautiful, continuous cycle. Step 1, you start with your cash, that 40 grand. Step 2, you sell a cash-covered put, and boom, you get paid a premium. That's income stream number 1. So let's say you agree to buy a $100 stock at $95, and for making that promise, you get paid $200. That's cash in your pocket right now. Step 3, if the stock drops to $95, you buy it. But hey, you wanted it anyway, and you got it at a discount. If it doesn't drop, who cares? You just keep that $200 and do it again. Step 4, now you own the stock, so you start collecting dividends. Cha-ching, that's income stream number 2. Step 5, while you're holding the stock and getting paid dividends, you sell a covered call. You agree to sell your shares for, say, $105, and you collect another premium for that. That's income stream number 3. Step 6, if the price goes up to $105, your shares get sold. You make a profit on the stock itself, and you keep all the premiums you collected along the way. Now you're back to cash, but more cash than you started with. You just take that money and start the wheel all over again. It's a machine for generating income at every single stage.
Now, I know this might sound a little complex, and I want to be perfectly clear about something. This is not a get-rich-quick gamble. Not at all. It is a system, it's a business, and it requires you to be an active manager, to understand the rules of the game, and to respect the risk.
A professional investor treats their portfolio like a business they own, and every good business runs on a plan. This checklist here, this is your business plan. You need to know exactly what criteria you're looking for before you even think about getting in. You need a target price. And maybe most importantly, you need to know your exit strategy before you ever place a trade. You have to manage your risk on every single position. And just like any good CEO, you have to regularly review your plan and make sure you're putting your money where it's working the hardest.
I love this quote. It's honestly one of the best ways to think about risk management I've ever heard. Look, you and I, we can't control the stock market. We can't control the economy. We can't control what the Fed does. That stuff is the Titanic. But what you can control 100% is whether you get on that ship without a lifeboat. Your exit strategy, that's your lifeboat. It's what gives you control. It's what makes sure you can get to safety if things go sideways. And all of this brings us to our final and maybe the most crucial section of all. The strategies and tactics we've talked about, they're powerful for sure, but they are totally useless without the right mindset.
To really make this work long-term, you have to make a shift from thinking like an employee to thinking like a business owner. If you've ever read Robert Kiyosaki's Rich Dad, Poor Dad, this will look familiar. It's the cash flow quadrant. Over on the left, you've got employees and the self-employed. They trade their time for money. On the right, you have business owners who build systems. The entire point of this strategy we've laid out is to move your investing activities firmly into that B for business owner quadrant. Your portfolio is not a job you do. It is a business you own, and it is designed for one thing: to produce income.
So, what does a B quadrant investor actually do? Well, they focus on acquiring assets for the long haul. They build systems, just like the wealth wheel, to generate cash flow. Then they take that cash flow and buy more assets, which creates this amazing compounding machine. They take the time to learn the language of money, to read a financial statement, and above all else, they know that they are in control. They are the CEO of their own financial destiny.
So let's circle all the way back to that cash sitting in your account. Hopefully you see it a little differently now. It isn't just a number on a screen, it's pure potential. So you have a choice to make. Is it going to be a freeloader, just sitting there getting weaker and losing value every single day? Or are you going to put it to work? Are you going to turn it into a valued employee whose only job is to go out into the world and bring you back more money? The choice, as always, is yours. Thanks for tuning in.